Welcome to the State of the Tape video, presenting an integrated read through the three-pillar method: macro, fundamental, and technical analysis. This video walks through 6 key areas. We will cover the house view and the 3 pillars: fundamental, technical and flow, and macro. Finally, we'll discuss the synthesis, playbook, and the call. The current market environment presents 3 critical reads: the bull case, the macro risk, and the reversal watch. Holding these together provides a surveillance dashboard for the week. The 3 legs, 1 call method combines macro, fundamental, and technical analysis. No single factor carries a call, but their combined posture informs the top-down read: index, then sector, then stock. Pillar 1, fundamental analysis, looks under the hood. The index is at highs, but the real story is in cash flows. The hardware and memory chain are showing the strongest AI cycle numbers, with multiples yet to catch up. The hardware chain leads because I build out spending targets servers, memory, and networking first. This is before software monetization, leading to clean earnings beats from box makers and memory names, not just the megacaps. Dell's earnings set the tone for the AI boom. The results included a 32% single-day move, a 250% year-to-date change, and a $4.68 EPS beat. Orders reached $24 billion, with a $27 billion raise, implying an extra quarter baked in. The Dell beat is significant because a $4.68 beat on an already high bar forces a re-rate across the entire hardware chain. A beat this large indicates a pull-up of estimates, suggesting structural demand. Dell's raised server outlook from $50 billion to $60 billion signals that demand is pulling forward, not stabilizing. The backlog of $24 billion in AI orders and the $27 billion raise suggests a structural NVIDIA moment for hardware integrators. The Dell-NVIDIA moment frames structural demand, not a blip. Key takeaways cover strong backlog, rising margins due to AI mix, and an ongoing re-rate. The discipline here is to watch for the pullback that holds, not chase the gap. Lenovo, the leading indicator in the chain, broke out ahead of the broader hardware tape. When the cheapest name moves first, it suggests the theme is broadening globally, not narrowing to US megacaps. Track weaker names as an early warning. Networking, the other half of the build-out, is represented by the HPE Juniper complex, which has moved 135%. HPE earnings are the next key confirmation point. A strong confirm suggests networking is funded as hard as compute. Broad hardware participation across compute, servers, networking, and PC refresh names confirms breadth within the theme. This suggests the theme has legs, separating it from a single stock story. Micron's $1,600 target is justified through a multiple expansion from a cyclical 5x toward a structural 15x, sitting below the S&P. This re-rate assumes memory is no longer priced as a boom-bust commodity. Multiple expansion depends on the long-term agreement base holding the cyclical floor. The test lies in the late February contract roll-off. If memory pricing softens before then, the story stalls, making this a critical date on the calendar. SanDisk shows a textbook estimate chase, where the market continually caught up to reality. We should read the movement as a process of re-rating, not simply a price change. ARM represents a sentiment trade, having run ahead of unbooked earnings. You must treat this as froth versus fundamentals. Trade it small with a hard stop, or avoid it, respecting the day trade stop around 327.20. Identify the type of move before reacting: parabolic, repricing, or froth. This framework helps distinguish between a bubble, a correction to new truth, and a sentiment-driven move. Name the bucket first. Parabolic moves like Tilray are cautionary tales, detached from earnings and driven by sentiment. Repricing moves like STRL are anchored to new earnings realities, where the stock catches up to the truth. The former is lethal to marry, the latter is real and tradable. Money rotates up the stack as hardware matures, moving towards software and security. The map issuedware to software to cyber. Watching this rotation is how you stay in the move without overstaying your welcome. As rotation runs, watch 2 things: cyber names like CRWD and PANW for the next leg confirmation, and the equal weight index for how much of the market is still left behind. This confirms rotation, not distribution. The squeeze complex, including PLTR, Hood, and SoFi, are momentum and positioning trades, not earnings re-rates. They should be sized accordingly, as squeeze trades with tight stops. Chasing these means renting the top. A squeeze loop is fueled by heavy shorts in retail, where buying forces short covering, pushing the price higher until exhaustion. The key tell is the absence of an earnings step change underneath the move. Fundamental analysis shows solid growth in real cash flows, breadth across the hardware chain, and a healthy rotation up the stack. Blind spots include multiple assumptions, frothy names, and macro risk sensitivity. Pillar 2 focuses on technicals and flow, determining where the price actually is. We look at breadth and positioning. understanding that a strong tape and an exhaustion signature can coexist, requiring vigilance. Market breadth softened into month-end, but is not broken. All 4 moving average lines softened in an orderly, broad manner. This orderly decline signals positioning into June, confirming a strong breadth tape. The 5-day moving average falling faster than the 20-day is a dip then bounce signature. This short-term washout occurs inside an intact trend, signaling a buying opportunity, not a market top. The breadth/flow line held above the 50% midline, the line between accumulation and distribution. The defense of this midline is the difference between a pause and a regime change. Stay with the trend until a decisive break occurs. Smart money, institutions, are passively positioned, absorbing supply on dips. Dumb money, retail, is where fear lives. The danger is retail capitulation, while institutions remain passive. The risk increases if the crowds converge. We are currently in a wide and status quo spread, where institutions are long and retail is cautious. A compressing spread signals a fading edge, while an inverted spread is a late-stage tell, suggesting a defensive posture. The last hour of trading serves as the single most useful flow read, using the cumulative +1 or -1 score as a proxy for control into the close. Relentless closing strength suggests institutions are absorbing supply. The current pace of closing hour absorption is comparable only to the 2014-2015 period, which preceded more upside, not a top. Crucially, the line is still climbing, indicating a trend continuation signal. The absorption reading is not yet at 5-year highs, meaning the bull leg has headroom. We have about 40 more net positive days of headroom until the prior reference, which is the difference between being late and exhausted. The absorption tell has a known failure mode, the stall, where the cumulative line flattens, historically marking a high. The one override is direct central bank buying, as seen in 2020, which trumps every internal signal. The cleanest signal in a strong tape is the undercut and rip, where price dips below a level, traps sellers, and reverses hard. Start with raw, open high-low close, then candlesticks, then indicators, to avoid premature noise. A doji prints when open and close finish in the same place after a wide range, signaling a stalemate between buyers and sellers. After a long run-up, this indecision at the highs is the first crack in momentum. The doji is the second bar of a 3-bar reversal pattern, the evening doji star. The pattern only completes if the third bar confirms with a strong down close. Discipline dictates waiting for bar 3 for confirmation. The exhaustion stack is characterized by 9 up weeks into a doji, with momentum diverging across daily, weekly, and monthly timeframes. This broad divergence is the most common fingerprint of a tiring trend. Divergence occurs when price makes a higher high, but momentum indicators make a lower high. The wider this gap, the more the move relies on borrowed strength. Despite the exhaustion signals, the MACD is currently back above its signal line, contradicting the stack. A split signal requires waiting for price and MACD to agree, prioritizing confirmation over conviction. On a larger scale, the trend appears to be a weekly rising wedge off the 2021-2022 base, nestled inside a 100-year monthly channel. This is a big-picture context, not a trade for the immediate day. Crude oil is carving a falling wedge resolving into a continuation triangle. A break above $119 flips the macro read to a combat or shock scenario. The current 9-week streak represents roughly a 20% run-up. Streaks like this often end in a doji, not an immediate crash, providing the exhaustion context for the current divergence watch. Individual names can flag a sector turn. A sharp reversal in a software bellwether like SNO is an early warning that the rotation into the software leg might be tiring before the index signals it. A reversal thesis requires more than just a doji. Confirmation relies on volume and participation backing the move. Distribution appears in the tape before it shows up in price, requiring agreement across price, volume, and breadth. Let's examine the technical and flow scorecard. Solid aspects include confirmed positioning by breadth and MDFI, constructive last hour absorption, a wide smart/dumb spread, and broad divergence across timeframes. Moving to Pillar 3, Macro, we address the risk shelf. The current situation is masking a live geopolitical situation. The entire bullish case rests on the expectation of a deal, and this expectation has a definite price attached to it. Here is the actor map for Iran. The split between pragmatists and hardliners creates diplomatic uncertainty, making any deal fragile. The wildcard, Rizee, raises the no-deal odds with his rhetoric. The Iran whipsaw timeline shows how diplomacy quickly collapsed into strikes, signaling a live, unresolved situation. Whipsaw headlines lead to elevated gap risk on the open. Manage exposure based on the event, not prediction. The Strait of Hormuz is the real lever for oil. Reported disruptions haven't been fully enforced. The distinction is key. An unenforced blockade is noise. A genuine closure would be a macro regime change, so watch enforcement. The key word is unenforced. The blockade isn't being enforced, preventing oil from gapping. Threatened actions contrast with the current lack of sustained closure. If it flips, oil gaps hard, leading to a macro risk-off. Sanctioned Iranian oil barrels are kept flowing via a backdoor China channel, a release valve preventing a full closure from biting. The macro oil shock is conditional, requiring genuine closure of the strait, not just headlines. Regarding the rumored $300 billion fund, the useful exercise is scale. It is approximately 176 times the 2016 era total. The figure is press-attributed and unverified. Trade the price, not the press narrative. The fund structure is mostly announced, not funded. Announced money doesn't move markets, wired money does. For the tape, this distinction is critical. We must verify every figure and watch flows, not pledges. The deal is currently priced, setting key QQQ levels for the macro trade. A signed deal targets 744 to 745. A no-deal scenario on Monday puts 725 in play. The market votes in real time between these levels. Here are the key QQQ levels stacked. 738 is the pivot, 725 and 744 to 745 are the two doors. The weekly close against 725 or 745 dictates the macro break. Intraday spikes are unreliable. Watch the close. If the deal fails, the bear path is a mechanical sequence of observable dominoes. The give-back chain starts with a deal failure, followed by oil spikes, rising 10-year yields, an inflation scare, and finally, a 3-week give-back. The 2000 analog showed a demand-pull inflation scare, Fed hiking, and a rapid give-back. The Nasdaq shed roughly 40% over about 10 weeks. Jumbo cuts didn't occur until 20% of the rally was already gone. The 2007 analog, the preferred map, involved an oil and energy shock layered on a credit-sensitive backdrop. This implies a slower roll and a deeper second leg. The shape may be less spiked, but the destination is lower. The 2007 analog, with oil and credit shocks, is the lean for the current setup. Confirmation of direction must come from price action, not relying on the historical analogy alone. The slow burn shelf highlights systemic risks. ECB flagged a crisis warning. Canada shows building recession signals. Private credit exhibits stress under the surface. All suggest caution, but none are acute threats. The one real concern is the margin debt rate of change, which is elevated near historic tops seen during the dot-com and GFC eras, but it has not maxed out yet. Leverage is the primary risk mechanism this cycle. The margin debt rate of change, or ROC, is climbing toward the danger zone preceding prior tops. It tends to resolve within about a month. Tagging the danger band without a Fed offset is the slow burn kill switch for the entire bull case. The 10-year yield acts as the transmission belt. Oil spikes push inflation expectations, moving the 10-year toward 5%, which pressures equity multiples. A sustained 10-year yield above 5% is the critical rate shock leg from oil to equities. Reading the diplomacy. Is it good faith or theater? The rhetoric and the announced not funded structure suggest the process is fragile. The market pricing a deal not yet earned represents the macro risk gap. Macro scorecard. Solid aspects include a tradable deal price level map, a clear Hormuz trigger, a sequential give-back chain, and a time-boxed margin debt ROC risk. The blind spots include unverified press figures, the reliance on actual straight closure, and the difficulty of timing catalysts amid headline whipsaw. This section synthesizes the three pillars: momentum, technical/flow, and macro. The legs disagree, creating a decision tree for market posture and execution. The pillars agree that earnings are real, Hormuz is unresolved, the rally is a deal bet, and margin debt ROC is the shared tail risk. They collide on momentum exhaustion versus room to run, and the market's discount versus unresolved risks. The decision tree outlines three potential outcomes for the week: a deal, a no-deal scenario, strike/breakdown, or chop. Neither resolves. The key is to react from a predetermined plan, not emotion. If a signed, durable deal lands, the bull leg is confirmed. Expect a gap up towards 744 to 745, oil easing and squeeze names extending. The posture should be lean bull, trailing risk, and adding on holds rather than chasing gaps. If the deal fails, the reversal watch is triggered. Expect 725 to be tested, oil to break toward $119, and a risk-off rotation. The posture is sizing down hard, respecting the divergence, and targeting the March 30th low. If the market chops, neither scenario resolves, creating a volatile range. The tape will drift 725 to 745, with volatility but no trend. The trap is forcing a narrative or overtrading the range. Posture should be trading levels with small size and waiting for the real catalyst. To flip the bull read, watch for flow breaks, positioning flips, or leverage tags. Specifically, any one of these converts room to run into the one concern, signaling the bull leg should be removed. To flip the reversal watch, look for a breakout holding, momentum agreeing, or the deal holding. If the breakout holds and divergences fail, the reversal is invalidated. Keep the off-ramp explicit in the plan. 3 confirms for the bull case. Last hour absorption climbing, QQQ holding 725 and reclaiming 745 on a deal, and software/cyber leadership confirming. 3 concerns confirming risk. 725 breaks, oil breaks above $119, or the 10-year above 5%, or margin debt row C tags the danger band. The first major binary event of the week is the Monday open and the deal/no deal outcome. Predefining the reactions is crucial so that market gaps don't dictate your response. For a gap up towards 744 to 745, suggesting a deal is priced, avoid chasing the open. Instead, look to buy the first pullback that successfully holds. For a gap down towards 725, indicating no deal, watch for an undercut and rip, and note that losing 725 on the close means tightening controls. Also on Monday, monitor HPE earnings. This event will provide insight into the hardware sector's tone and should be interpreted in conjunction with the index's performance. The CPI release is the fuse for a potential market giveback. A hot inflation number combined with a no-deal tape presents the worst-case scenario. A hot CPI print activates the rate shock leg, pushing the 10-year yield towards 5% and pressuring multiples. An inline rating maintains the status quo, shifting focus back to the deal. A cool print supports the bull case by easing rate pressure. The most concerning combination is hot CPI plus no deal, potentially triggering a sharp giveback. This is the scenario where you should reduce your market exposure to the smallest size. Computex is the forward catalyst for the bull leg. Remember, it's about coordinates, not dates. An event cluster for NVIDIA and Microsoft news, not a single moment in time. The Computex setup focuses on NVIDIA and Microsoft, refreshing the AI hardware narrative, supporting the Pillar I thesis. Watch for guidance and product cadence, chain read-throughs, and distinguish between sentiment and substance. The risk at Computex is a sell the news event for names trading on froth, leading to potential unwinds similar to ARM. Do not mistake the short-term event for the long-term trend. The surveillance dashboard highlights critical levels and upcoming catalysts. Key levels include QQQ at 725 for the no-deal line, and 744 to 745 for deal upside, as well as oil at $119 and ARM at 327.20. Compartmentalize your trading by keeping separate books for day trades versus swing trades. Mixing them turns a good day trade into a bad investment. Define the time frame at entry. 1 ticket, 1 clock. The day book uses hard stops and is based on OHLC plus the last hour tape. The swing book is thesis-driven, with wider stops and smaller size, anchored on earnings and structural elements. The principle for sizing into a binary week is size for the gap you can't see, not the one you expect. Reduce gross exposure before the event and avoid oversized overnight risk. Your morning routine should be a repeatable, emotion-free process. Macro check, level marking, breadth/flow analysis, structure review, and, finally, formulating a plan. Always define the stop and size in advance. Hold your view as probabilities, not predictions. Weight the scenarios, size to the probability, and pre-commit to your off-ramp. Let the tape resolve the call. Right process is superior to the right forecast.